Hey traders, Scalps for Lifted Trades. Welcome back to the channel. Today I want to dive into another crucial concept, and that's draw on liquidity. Now, understanding liquidity and where price is likely to be drawn is essential for making informed trading decisions. So let's go ahead and break it down. Now, here on the screen, we have a chart illustration showing draw on liquidity. So let's walk through it, see what it means, and how it plays out in real trading scenarios. First, let's talk about what we mean by liquidity. Liquidity in trading refers to areas in the market where there's concentration of orders. In other words, these are levels where we expect a lot of buy or sell orders to be sitting. Price tends to be attracted to these levels like a magnet, as there's more interest in those areas. Now in this chart, we see two marked areas: buy side liquidity at the top, sell side liquidity at the bottom. Buy side liquidity represents areas above recent highs where there may be a cluster of buy stop orders from the traders who are shorting the market, as well as buy orders from breakout traders. Similarly, sell side liquidity represents areas below recent lows where there may be sell stop orders from long traders who are looking to protect their positions. So why is it called draw on liquidity? Now think of these liquidity zones as magnets, as I said previously. Price is often drawn towards these areas because that's where the liquidity is. This movement can be driven by large players or institutions that seek out these zones to execute large orders. So in the example on the screen, you can see how price initially drops down towards the sell side liquidity at the bottom. This move clears out the orders in that area, essentially grabbing liquidity. After that, price rallies up towards the buy side liquidity zone, which is located above the recent highs. The market hunts for these liquidity areas to complete its cycle of gathering orders before potentially reversing or continuing in a trend. Now, let's talk about how you might actually enter a trade using draw on liquidity. First, identifying liquidity zones. So mark out areas of buy side and sell side liquidity on your chart. These are typically found above recent highs or below recent lows, where there's likely to be a cluster of stop loss orders. Second, wait for a liquidity grab. Once you have your zones marked out, be patient and wait for the price to approach one of these zones. So for example, if the price is moving downward, wait for it to reach a sell side liquidity zone. You want to see a liquidity grab, where price dips into the area to trigger sell orders and then reverses back up. Thirdly, confirm reversal with a signal. After price taps into the liquidity zone and shows signs of a reversal, look for a confirming signal to enter your trade. This could be a bullish fair value gap, an engulfing candle, or any other entry signal you use. The idea is to wait for confirmation that the price has indeed reversed after capturing liquidity. Fourth, enter with a target at the opposite liquidity zone. If you entered long after the sell side liquidity grab, set your target at the buy side liquidity zone, as price will likely be drawn there next. Similarly, if you enter short after a buy side liquidity grab, target the sell side liquidity zone. By aiming for the opposite liquidity level, you're positioning yourself to ride the natural draw of the market. Fifth and final step is manage risk. Place your stop loss just below the liquidity grab if going long, or just above if going short. This helps protect your trade if the market doesn't go in your favor. So a quick example, let's say price drops into a sell side liquidity zone, triggering a wave of sell orders and clearing out stop losses. You see a sharp reversal, signaling that liquidity has been grabbed and price is now likely to rally up. You could enter a long position here with your target set at the buy side liquidity zone. Now, for us traders, understanding draw on liquidity helps us anticipate where price might move next. So knowing these zones allow you to enter trades with a greater understanding of price targets and avoid getting trapped. So that's a quick breakdown of draw on liquidity and how you can use it to enter trades. If you found this explanation helpful, make sure to like the video, subscribe for more trading tips and strategies, and let me know in the comments if you have any questions or any other topics you'd like me to cover. Thanks for watching. I'll see you in the next video. Scalps are out.